Hello everyone. My name is Vikas Agrawal, and I'm the founder of a company called AIF and PMS Experts India. Well, AIF and PMS Experts India is now emerging as one of the largest platform for investing in alternate investment funds and portfolio management services. What we are witnessing of late is that a lot of investors, those who have been investing in direct equities on their own, or maybe some of them who have been investing in mutual funds, have shown a lot of interest towards investing through AIFs and PMSs and participating in Indian capital market. So what we essentially do, we are a team. We are a team of 15 people, and we sort of manage our investors' money. We allocate money and give allocation to those who are deserving portfolio managers. So with me, I have a very good deserving portfolio managers who have been investing in capital markets for over 15 years. With me, I have Mr. Himanshu Upadhyay from O3 Capital. So hello, Himanshu. Welcome to the show of Ask the Expert.
Yeah, hi. Good afternoon, and thanks for your kind introduction and giving us an opportunity to share our views.
Right. So thank you for accepting our request, by the way, Himanshu, and taking the time out from your busy schedule. So for the benefit of our audience who have joined here for the first time, let me have the privilege of introducing Himanshu. So Himanshu brings about almost 1.5 decades of experience on the table, and he's from IIM Kozhikode, and I've worked with Primerica before joining O3 Capital, where he's managing PMS, more particularly this small cap strategy. Himanshu, the format is why we call it Ask the Expert Show is because we invite industry experts like you. We try and read your mind, try and understand what's happening in and around the world, try and read your mind in terms of what is your house views on equity markets and various asset classes. And then we try and understand your investment philosophy and how do you sort of identify the stocks in your portfolio and ride through the growth journey of those companies by identifying them at an early stage of their growth curve. So we'll start with, so the format is simple. I'll be asking you a few questions on behalf of our investors. So it's going to be a conversation. And if you wish to share any slide, you can share your slide. So I'm I'm making you host as well so that you can
Okay.
get the slides. If you wish to present any data points for our audience, so I can see that there are a lot of people who've already logged in now and joined the show. So my first question, Himanshu, is if you can talk to us about your organization first, which is O3 Capital, and your PMS and overall the structure of the organization. And then I'm going to ask you my second question. Over to you.
No, see, O3 PMS. So, see, it's a very homogeneous team. Okay. And we all have been working with as a team for many years. Okay. And we know each other for a very long period of time. Okay. So, Sundaram is the person who is the CIO and who is the front of or the first man in the organization. Let us
Mr.
say.
E.A. Sundaram, right?
Yeah, Mr. E.A. Sundaram. Okay. So with E.A. Sundaram, I started my journey since 2010. Okay. And then there is Rajesh Keswani. Okay. Looks after the sales and head of sales also. He has been with Sundaram for much longer than that. He was with him even at HDFC and previous organizations. And then we have few more people who were with us at PGIM and who have come to this place, okay, O3 PMS. So we all know each
Guys are
other.
based in Bombay or in Bangalore?
No, the PMS team, the investments team sits in Bombay, okay. So yeah, in the way we have been knowing each other for a very long period of time. Sundaram started this PMS in 2019, okay. And Sundaram and Rajesh were the starting persons, and then I have also joined them in 2021. Okay.
So you got the license in 19, so you bring about almost 4 years of track record on the table as far as your first strategy is concerned.
Yeah, for the first strategy, we started in 2019 May.
Okay. Wonderful.
So for that strategy, the performance is from 2019 May onwards.
Can you also talk about a bit about your other verticals within the organization? So you have investment banking, or how is it? The background or DNA of the organization?
Yeah, so the business was, or it was an investment banking, O3 Capital. Okay. And they wanted to diversify into various other businesses also. They started with alternate investments. Okay. And they got a license of PMS in 2017 onwards. And so the alternates started in 2017. And then those were more of passive strategies which they started with. But from 2019, they wanted to start something on active. And that's when we joined this O3 Capital team. And under the O3 umbrella, okay. Again, active strategies or PMS schemes, okay. The AUM of the active strategies is now more than 1,000 crores, which we manage here, okay. The other verticals are also wealth, which we also do, okay. But that's a separate team, separate structure for the organization. There is a glass ceiling between us and the wealth team. And but yeah, so investment banking, wealth, and investments. These are the three main verticals.
I understood. Now coming to markets. So, what's your views on the markets? Because small cap, mid caps, a lot of people are saying that looks to be little overvalued, and historical P, which used to be in the tune of 20, 21, 22, have been inched up towards 27, 28 kind of Ps, and broadly some of them are trading even on higher side. So, what's your views over there, Himanshu?
1 second, I'll just like to quote someone, or
Sure.
it would be just helpful. Okay.
So, please take your time.
To see what the greats have said. Okay. And the most smallest is the Peter Lynch. Okay. More money has been lost trying to anticipate and protect from corrections that actually in them. Okay. And the other one also is investing is where you find great companies and then sit on your S, which is Charlie Munger, which could be as direct as that. Okay. And to a certain extent, in the organization, we also have a similar philosophy. Okay. And our thoughts are trying to time the market is not a great way to invest. Okay. And very few have succeeded in doing that. Okay. For us, investing is about searching for good companies run by good people, bought at cheap valuation, and sit with them for number of years. Okay. In between, there will be volatility. Okay. But what you need to do is at the time of researching, which is before investing in a particular company, you should have taken patience, or you should have the patience to look at everything in when you are buying or researching. And you should have a confidence that we are buying a good company, decent management at a valuations which are cheap. And when you are buying a cheap valuation, the other thing is also you will have a good dividend yields. Okay. Or the company may be doing buybacks at those periods of time, which also helps you to be confident to sit with a company for a long period of time. Okay. So our thought is that whatever we are buying currently should fulfill these criterias. Okay. And what we have seen, okay, in my previous organizations also, see, if you take a peak to peak market, okay, there will be many companies which would have done far, far better than the index returns. Okay. So some of the companies which we held in my previous organizations also, and when we, let's say, a case like APAR or a JB Chemical, which were some of the large positions for us historically. From the peak of 2017 cycle or a small cap peak, these stocks have done much, much higher return than the index which has given. The index today on a small cap has given 17% returns, okay, CAGR from in last 8 years, okay. So it is from something like 2016, the small cap index has given that returns, okay. But you will find number of companies which in last 8 years would have given much higher returns than this 17% which have been given by the benchmark. So the focus for us is a bottoms-up approach, and that is the place where we are different, okay? And we think we provide value addition in the market, that we like to look at each company on a standalone basis. And once we are confident that the checklist what we have in our mind is fulfilled or all ticks are there, and we think we'll be able to uh, accept the volatility, okay, which will be there, okay, eventually, then only you buy and sit with the company, okay. So even when this strategy, so in last 1.5 years, we have exited only one stock, okay. So that is the way we are looking at it, okay. And we started with generally portfolios with 15 to 20 stocks, okay. And we don't run a model portfolio, okay. So what we do is, so model portfolio means all clients may not have the same portfolio. Clients which are joining today will have a very different portfolio than the initial clients which joined, because something else was cheap on that particular day, and some of those stocks may not be that cheap, okay. So today something else may be cheap, so we'll like to, and the client who joins today will be aligned to the model portfolio for this month, okay. And the companies which we are in the model portfolio currently are the companies where we think a substantial growth is there, operating parameters are continuously improving, and the reflection of the change in the operating parameters is still not available in the, or is not seen in the profit and loss, balance sheet, and the cash flows of the company. The thought process is to remain invested with the company for 5 years or more, okay. So that is the whole thought process or genesis with which we look at it, okay. We don't look at what the index valuations are in a nutshell, okay, or what is into the index. So the result of bottoms up approach has been that our overlap, even with, let's say, with BSE 250 index, is less than 5%, okay. And the other thing is, even if you look at the other small cap products which are available in the market, our overlap with those products is less than 6 to 7%. Okay.
Yeah. I'll come to that. I'll come to that. So now my second question is, how do you run the strategy? What's your investment philosophy? And second question is, what kind of performance has been delivered? These are the two questions.
Okay. So the first question was our strategy. Okay, what is our strategy?
Yeah.
So I'll
Overall
describe.
strategy of the group, and then your strategy within that. How do you pick up the stocks?
See, in the group there are means 4 products which are actively going on. One is, so, but all have different strategies. Okay,
Okay.
I'll like to focus
You
on
talk
this
about
product
your small cap. Yeah.
because that would be the thing. See, the thought process in small cap strategy is that uh, you buy companies when there is some significant change which is happening, okay, and when that significant change is visible, and you think that the company, because of those changes, the profit and loss, balance sheet, and the cash flow of the company will improve and increase materially over next following few years, we like to invest in such a story, okay. Now what does this mean, and what is the significant change we are talking? See, generally we have seen historically, let's say, last few years were very good for chemical companies, okay. And what we saw was that the industries in China, the pollution control norms became very, very tight, okay. That meant that the cost of manufacturing in China increased quite materially for chemical companies. And a lot of that manufacturing shifted to India, and Indian companies benefited out of it. And many small cap companies became mid cap and large cap in chemical space. I would again say that before that, if you look at it, pharma companies, okay, we saw a lot of patents or products which were under patents moving out of patents from 2004 to 2013-14, or which was a period of patent cliff. and a lot of small pharma companies, mid-cap pharma companies became large cap. Okay. So the change could be because of an external parameter, and because of those changes, you think the opportunity for this particular company can increase quite materially. Okay. And that is the whole thought process with which we like to work on. Okay. That you are looking for large change. And once you think that that change is there, then you start looking at the operating parameters of a particular company. Okay. Now, operating parameters for a particular company can be, let's say, we had a very large position in capital goods. Okay. Uh, and the position was because we felt that for last many years, not much capex has happened into the industry. And the renewables, okay, and all these things will require a lot of capex, which will happen. Okay. And hence, certain companies should benefit out of that whole thing. And when we saw that the budgets for the governments and so many organizations showed a phenomenal growth in renewable or the way wanted to spend, it became very clear that this is a capex which is very, very likely to happen. Okay. Then we said that the operating parameter for a capital goods is how much is the order book? Are the order books increasing? And again, once the order book starts increasing, then only it will start getting into revenue, profitability, and the cash flows. Because first you give an order, and once you have orders, you will start manufacturing. Okay. And the other important part was what type of gross margins the company could make, so that the more the gross margins, the more the economies of scales would be there. Okay. So those were certain operating parameters which helped us that these companies are likely to benefit out of the capex which is going to happen. Okay. And that is the way we start focusing on, or we start selecting into our particular stories, that there has been significant improvement in the macro level or macro of the particular story. Then are the operating parameters continuously improving? Once the operating parameters have improved, are the valuations still cheap with a multi years of growth opportunity? And once that is there, we'll like to invest in a particular stock. Okay. Now, the important part is how do you manage risks in small cap when you are building a portfolio? Okay. And I think managing the risk is the first priority for us. Okay. Whether it is in all our products. Okay. And the way we manage risk in small cap space. Okay. So we said why companies have failed historically. Okay. Especially small cap companies. And we said that there were certain fundamental reasons because of which the companies failed. Okay. Historically, small cap. So one was high debt to equity on the balance sheet. So we said that we will not like to invest in companies where debt to equity is more than 0.5. Okay. The second was credit rating. Okay. See, if you have a high debt to equity, okay, and your credit rating is poor, in the downturns, you may not be able to raise capital which may be required for capex or committed capex or for increased working capital. So, in the difficult times, if your leverage is very high and your credit rating is poor, you will not be able to raise debt, okay, in the bad times. And hence, we said that credit rating below double B will not invest, okay, and leverage more than 0.5 is not what we want. The average credit rating of the portfolio of companies is A plus. And why we look at credit rating? See, when we are looking at as equity investors, our focus is how much will be the upside, okay, and what can happen. But the credit rating, the thought process is, will the company be surviving? Will he be able to pay the principal and interest on whatever outstanding debt instruments are there over next 5 to 10 years? So that is why we focus on credit rating, which tells us that the sustainability of that company and organization. Second is, what is the promoter shareholding, and is it let's say pledged or not pledged? See, one of the other things, if you look at it, a lot of companies which have faced crisis historically in the country had very low promoter shareholding. Okay. And most of their shares were pledged. Okay. So we said that, and what it also means is promoter shareholding low means he may have some other interest than this particular company. And this particular company where we are investing may not be a priority for the promoters. So the first thing is that promoters should have a decent skin in the game. Secondly, he pledge on the promoter shareholding means his personal balance sheet is leveraged. There is a lot of leverage on his personal balance sheet, and he will always have an incentive to do something which may not be the interest of minority shareholders, okay, which are us. Okay. So let's say if I have a company ABC and I own 60%, and all my 60% of shares are pledged, means I have a leverage on my balance sheet, or personally I have leverage. So it will always be in my mind that how to reduce that leverage. And I may do something which may not be the interest of the other shareholders. Okay. So that's the second thing, is that promoter shareholding should be high, and he should not have pledged shareholding. The current, if you look at it, average promoter shareholding of the portfolio companies is 60%. The maximum the promoters can own in a particular company is 75%. So currently it is 60%, which is good. The third is, we don't want to invest into IPOs, and we don't want to be venture capitalists. So our focus is that we should invest in companies which have at least 10 years of track record. Okay. And why 10 years of track record? Our hypothesis is that over those 10 years, there may be some bad periods also in the company's history. Okay. And we want to see how the bad years the company behaved, and how severe was the impact of those bad years. Can those bad years be so difficult that a lot of companies did not exist or could not last out of it? And how did this company manage those 10 years of history? Okay. So, and history gives a lot of idea of what the company has done, and how they have behaved, and what can be the likely behavior of the management and the promoters in future. So that's why we always want to have a 10 years track record. Now, the other two important parameters are, again, we don't want to invest in companies which are too diversified. Okay. If the companies are too diversified, again, the probability of us making an error becomes very high. Okay. So we want to focus on companies which have 2, 3 business lines. Okay. And so that we have more clarity on what is happening in the business. And finally, we don't want to invest in companies where the business model is continuously changing. Okay. Because if the business models is continuously evolving and changing, our chances of error will be very, very high. Okay. And one part of risk management is to reduce the chances of error of judgment. Okay. And we focus on these 5 parameters so that we don't commit lot of errors in our portfolio management, or we try to minimize the mistakes. Okay. So this is the risk management strategy. And yeah, I already stated about the
Sure. So can you put up the present slide and show us the performance of your schemes and the other scheme also, for the benefit of our investors who have logged in?
1 second. Huh?
Yeah.
Is this visible?
Yeah, yeah. So when was this launched? 1 year back.
So it was launched in 1st August 2022.
And you joined
And
in 2021. So after
yeah,
1 year of your joining.
yeah, after 6, 7 months of my joining, this product was launched. Okay. So if you look at it, the returns have been 56% since inception. And the benchmark which we need to take is BSE 500 TRI based on SEBI regulations, which is around 23%. 1 year is around 59%, and the BSE 500 TRI is 27%. Okay. And so this is the returns. And yeah, I spoke about the portfolio price to earning, which is also this statistic is important, that when we are saying that we are trying to build companies where the valuations are low and where we can sit for higher long period of time, that is the reason why we want to have a low price to earning
Is this
ratio.
the strategy? Can I say this tilted to more towards value side, which is the style of Mr. E. A. Sundaram?
See, we want to buy growth. Okay. So a lot of companies, if you will see at it, okay, let's say a Shobha or a Great Eastern Shipping, Ashiana, these are high growth companies, okay, today. Okay, even let's say an APAR company, what we bought, okay. So last year they did, today only the results came. The EPS of FY23 was 165. It is most likely, based on the Bloomberg estimates, that FY24 would be 225. Okay. So 20% growth rate is what people are expecting in the business. But one thing is, we don't want to pay for that growth. Okay. See, if you start paying for growth and very high multiples, eventually the returns may not happen in that way, okay, or what you want. Let us break the what gives you return. There are two components of return making in the market. One is your EPS growth rate. The second is price to earning expansion. Okay. So let us say we have a buy a stock where the EPS is 10 and the price to earning is 15. Okay. So today I am paying effectively 150 rupees for a particular stock. But hypothetically assume that 10 rupees EPS becomes 15 rupees. Okay. And in next 2 years, and my EPS goes from 15 to 20, that stock will become 300 rupees. Okay. PE ratio into the EPS. Okay. So the EPS moved from 10 to 15 and PE ratio moved from 15 to 20. So what was 150 becomes 300 rupees. Okay. So to make good returns in market, it is both these dimensions are important: growth in EPS and portfolio price to earning. Okay.
True, true.
You cannot look at only one parameter and invest in a particular venture. Okay.
So there are two questions. If you're done, you want to
Yeah, yeah.
add? So why is it called a special situation? So what is the situation you see is a sort of special here?
No, see, I'll tell you certain few names, okay, so that it helps us. These are top five names, but other names are also there. I, so let's say the current names where we are very, very keen on or interested on. Okay. So we are seeing a new education policy which is coming up. Okay. And new education policy 2020 means a lot of change of school curriculum will happen. And again, syllabus is going to get changed. And what will also happen is that new subjects are going to come up, which will be vocational subjects from sixth standard. Okay. The structure of board will also change. Board will become a 12th class. So all those changes are going to be a big change for the publishing company. Okay. Now the competitors for a publishing company are second-hand books. Okay. But whenever syllabus change happens and curriculum change and new subjects get introduced, the second-hand books become redundant. And the second-hand books are nearly 50% of the market. Okay. So that is an opportunity we see in education, which is going to change. Okay. Or the new introduction of new education policy should lead to publishing companies into, so especially in school publishing, will do pretty well. So this is a special situation. Syllabus change will not happen every day. Okay. Syllabus change is happening currently, and that was an opportunity we like today. Okay. Something like, let's say, real estate, where we have a significant weightage in the older portfolios. Okay. We saw that regulations were changing in that particular sector, and accounting laws were also changing, or accounting rules. So GST, RERA, the two important changes happened. Demonetization and the focus of the government to reduce cash component significantly in the economy. Okay. So these two, three were important changes. And what we saw was the sector had not done pretty well for many number of years. And few companies were going to get more and more share of the market, okay, because of the regulations and people's willingness to buy more from the premium developers or the larger, more disciplined players. Okay, so that was a special opportunity. What we felt that in the residential real estate sector, the consolidation will lead to few companies becoming very, very large. Okay, and hence we chose three companies. Okay, a company like Shobha, which is into Bangalore, a Kolte Patil, which is into Pune, and Ashiana Housing, which is into North. We felt that these were the three markets where job creation is going to be good, and which was happening, okay, for 2.5 years back. And these segments will do pretty well. Okay. And hence we chose that as a opportunity that the consolidation is a once, let's say, phenomenon in 20, 25, 30 years. Okay. It will not happen every means. Once few players will become larger, they will dominate the business. Okay. Something like, again, a Great Eastern Shipping is there. Okay. Now, what happened was there was your war between Ukraine and Russia, and all crude oil which was going to Europe and gas through the pipeline was not going to go through the pipeline. Okay. And that crude oil from Russia will move to India, China, Latin American countries, even Africa. So the demand for ship was going to increase. Okay. Especially the crude carriers and the product carriers. Okay. And the other thing was even Europe started importing more from Middle East and from US. Okay. Which meant that the demand for ship was, which was early, or the European demand was being met through the pipeline from Russia, is now being met through the uh, shipping routes, and the demand for ship had increased significantly. And it was once in a, let's say, I don't want to give any years, but that was a special situation we felt. And we felt the company will do pretty well because of its fleet. And most of their fleet is outside India, or focused in working outside India. Okay. Though the ships are Indian flagged, but majority of revenue for their shipping comes from outside India. So that is the way we look at situations which are evolving, and we try to look at the companies from our universe which may benefit, okay, because of that special situation which may arise, and uh, and try to buy earlier than the market. Okay.
Okay, we got it. Got it. So great. It was a pleasure talking to you. We
Okay.
basically gave a time limit, so we keep this show for 30 minutes. So once again, thank you so much for sharing insights about your strategy, the way you select the stocks, and you've really delivered very good returns in the hand of investors. So congratulations on that. With that, we'd like to conclude the session here.
Yeah. Thanks. Thanks for your uh, time and giving us an opportunity to share our thoughts.
All right.
Yeah.
So thank you
Thank you.
everyone for viewing the show. And if you wish to know anything more about the strategy, you can reach out to us at aifpms.com and book your call with a team of experts. And we will share more insights about the strategy. Thank you.